Thank you very much, Jay. Good morning or good afternoon, everybody. Thanks for your time. I'd like to thank the organizers for a fantastic conference. Great job. And I'd like to thank Jay and all the newsletter writers for recommending and recognizing the golden opportunities that have stood up here and spoke about today. I would like to talk to you about a high-grade, high-margin, low capex opportunity. And hopefully, my goal is that you leave this presentation as excited about Golden Rain as I am. Cautionary statement, I'll let you read this on your own time, but it is an important piece of information. We're located in Nicaragua, in north-central Nicaragua, which is about 10 kilometers south of the Honduran border. This is a pro-mining government, 25-year exploitation concessions, a reasonable tax regime with a net profits tax of 30% and a 3% NSR. There's a skilled labor force available, modern infrastructure, repatriation of capital and profits, and limited gold exploration. Gold's the leading export commodity, though, in the country. There are 3 operating mines currently, and we hope to be the 4th. The San Albino project falls within the lowest quartile and is situated within this great jurisdiction, and it's underexplored by modern standards. Why San Albino deposit? It's compelling economics, high grade, low capex, and fully scalable deposit. We have a clear development path, which you don't find with most juniors, in that we have a $15 million gold streaming arrangement in place with Marlin Gold, and that is actually the budget to build this mine. It's a small 250 ton a day operation, but the margins are huge because of the high grade nature. There's significant upside potential as well on this deposit. It's open at depth and along strike. And currently, the streaming arrangement that's in place and the 1 million ounce 43-101 compliant resource that we have represents only 2% of our land holdings. Anything outside that 2% is actually not subject to the streaming arrangement and is 100% owned by Golden Rain and is loaded with high-grade assays and values so far with limited to no drilling. The building of the mine is going to give us the funds at no dilution to the company out of cash flow to explore the rest of the property. So this first high-margin gold project with robust average grade of 8 grams per ton. I don't think there are other open pits out there, at least none that I know of, at that grade, that surface, open pittable, at a reasonable stripping ratio. Our PEA numbers have given us an internal rate of return of 37.4 after tax and royalties. The average diluted grade, and I have to stress that the dilution in this case is 40%. That we're using for our dilution. It gives us over 8 grams for the combined open pit and underground, and the open pit alone is just over 7 grams of gold equivalent. This gives us, at a 5% discounted net present value of over $100 million, our initial capex is $13.9 million. This is incredible. A lot of people don't believe it, but what we're building is basically a pilot plant and nothing else. We are going to contract mine. We're going to do a boot power system where it's build, own, operate, transmit. We'll buy power per kilowatt hour, and we'll operate this at quite an expensive operating cost per ton. $111 a ton is probably one of the highest cost open pits you'll see, but that works out to $464 an ounce all in because of the high grade nature of this. So we don't want to dilute the company. We're keeping the capex down. The operating cost is going to be high at the start of the project per ton, but very low per ounce because of the high grade nature. Paybacks within 2.2 years at a $1,200 gold price. The initial capex requirements, as I said, all we're doing is building a mill, a CIL plant with a gravity component up front, 250 tons a day, tailings, which will be dry stack tailings. Everything else will be contracted and part of the operating cost. The margins on this, though, $786 according to the PEA is a huge margin at 20,000 ounces a year. We will immediately use that margin and the cash flow to expand to 500 tons a day, probably within the first year, at which time we'll be producing 40,000 ounces a year at under $400 all-in cost. Sounds too low to be true, but it's because of the grade of this deposit. It's just well endowed grade-wise. This puts us in a high IRR, low CapEx situation, which I call the sweet spot of this chart of IRR against CapEx expenditure. We're spending a very limited amount of CapEx, but getting a very significant internal rate of return, which at 250 tons a day puts us quite high against our comparables, and at the top at 500 tons a day, even beating Rocks Gold, which is a very high-grade underground deposit in West Africa. The PEA highlights, again, at 250 tons a day. You can see these numbers, the cash costs of $428 at 250 and $359 at 500 tons a day. I don't think that you'll find many, if any, with that type of costing that doesn't have a byproduct. The San Albino deposit, the open pit that we're talking about, is going to be 4 small pits at the moment. We're still drilling. It's going to be 250 tons a day, 5.2 to 1 strip. The oxide grade cutoff is 1.46 grams. The fresh rock is 1.4, which gives us the average diluted mine grade delivered to the mill of 7 grams per ton. This is over $200 rock, people that we're delivering to the mill diluted. Continuity, a lot of people ask about continuity. There was some old workings, Spanish workings, and some old workings from the 40s in this area. San Albino actually operated in the past as a direct drive, Ingersoll Rand mill from direct drive from the river back in the 40s. And there are old workings that we've actually gone in, pumped out, and sampled. So we do have continuous high-grade veins that we're looking at. The veins are dipping at 28 degrees, and therefore are very shallow, and we get a lot of ounces per vertical meter because of that, which makes it ideal for open pit. And the veins themselves are stronger than the surrounding rock, and that's why the hills are formed by these veins. So as you're mining down dip, you're mining downslope of the hills in the area too, which makes for a much lower stripping ratio. We started permitting in June 2015. We've got 2 key permits already. We're looking for 2 more. We're told if we keep our schedule that we're working on, that we'll have our permits in August of this year, and we'll start breaking ground in September because we do have the money to build this already. And if that happens, we'll be pouring our first gold at the end of next year. This is a rapid, quick build because it's a small project, but it's huge margin. And we expect to get cash flow at 500 tons a day of $1 million free cash flow per month, of which we'll spend a significant portion of that looking at the rest of the property, which has never been had any modern exploration, and it has high-grade results in all the old workings moving forward. That little box that says Marlin Area of Interest, that's where the gold streaming arrangement is and the current 1 million ounces. The rest of the red and yellow concession is our ground that has a lot of high-grade sampling in trenches, old workings, etc. That little box will be the mine that we build, which will build the business from the cash flow to look at the rest of the property. So it's a 43101 compliant resource, near-term production, PEA study completed, permitting process initiated, and gold stream funding in place to build the mine. Outside of this area, which isn't subject to the gold stream, we have Las Conchitas, which initial drilling has confirmed down dip continuity of highly mineralized zones. We're getting values up 40, 60 grams per ton gold, incredibly high grade. As well as potential for further ounces similar to San Albino. To the south of that, we have the Algolfa mine, historic mining operations that was washed out by a flood. There was a resource calculation done later on in the 40s, which is non-compliant anymore, but it said that there was 800,000 tons of 18 grams per ton left. That's $700 million worth of gold down at Algolfa that we want to explore. And the remainder of the concession have numerous high-grade targets awaiting further exploration. When we started in 2009, we had some drill holes down at San Albino. We knew we were onto a discovery, but you can look at the rest of the concession. There was nothing done except old workings. Today, every red dot that you see on this map is a very high-grade sample of either trenches, old workings, dumps. We've actually dubbed this the measles map, and it's the first time in my life I've actually wanted to have a bad case of the measles. Looking at the southern area, the San Albino deposit within the Marlin area of interest, if you look to the south of that, Las Conchitas and El Golfo, you can see the values, you can read them yourself. The drilling that we did at Las Conchitas is we drilled 5 holes outside of San Albino, that's it, on the entire rest of the property, and every one of them hit. And we're getting, values from surface of 21 meters of 7 grams per ton, 3 meters of 63. I mean, that's 2 ounces per ton gold. Trenches that are high grade, and we're getting it throughout the entire property. So this is a compelling investment. I urge you to take a good look at it, and I know I can hear stomachs rumbling now, so I'm going to keep this right on time. This is something you should really look at. It's one of these unique cases where we're funded to development. The development will produce cash flow that will be used to explore the rest of the property. So it's not only going to be a highly profitable production story, it's also a very, very exciting exploration story at no dilution to the company. So thank you very much. We have 160 million shares outstanding. We have just done a financing. We have a little over $3 million in the bank to get us to the point where we draw down and build the mine. So thanks for your time and enjoy your lunch.